Welcome to the world of investing, where fortunes are made and financial futures are secured. Today, we dive into the mind of one of the greatest investors of all time, Warren Buffett. Warren Buffett, often referred to as the Oracle of Omaha, is a name that resonates with power and wisdom in the realm of investing. Born in the heart of Nebraska, Buffett's journey started with selling chewing gum door to door, and eventually led him to become one of the most successful investors in the world. His company, Berkshire Hathaway, is a testament to his financial acumen, consistently outperforming the market and turning modest investments into vast fortunes. But who is Buffett, really? He is a man of simplicity, known for his frugal lifestyle and humble demeanor. Yet, his investment strategies are anything but ordinary. He is a firm believer in value investing, the art of buying stocks for less than their intrinsic value. His philosophy revolves around the concept of buy and hold, which means investing in companies for the long term rather than trying to time the market. Now let's talk about investing. Investing is the act of committing money or capital to an endeavor expecting to generate an income or profit. It's about growing your wealth and securing your financial future. And it's not just for the rich. Anyone can start investing with a small amount of money. Why is investing important, especially for beginners? Well, it's simple. Investing allows your money to work for you. It's a way to set aside money while you are busy with life and have that money work for you so that you can fully reap the rewards of your labor in the future. Investing is more than just making money. It's about planning for your future, achieving financial independence, and making your dreams come true. And remember, subscribing to our channel doesn't cost a penny, but the knowledge you gain could be priceless. So don't forget to hit that subscribe button. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." Let's explore what he meant. When we look at the world of investing through the eyes of Warren Buffett, we see it not as a high-stakes game or a quick path to wealth, but as a long-term strategy. It's akin to planting a seed and nurturing it over time, allowing it to grow and bear fruit. This is not a sprint, it's a marathon. Buffett's view on the stock market is that it's a place for long-term investments, not a casino where you can make or break your fortune overnight. He emphasizes the importance of patience, a virtue that many of us often overlook. In the realm of investing, patience isn't just a virtue, it's a necessity. It's the ability to wait for your investments to mature over time, resisting the urge to cash in at the first sign of profit or panic at the first hint of loss. But patience alone isn't enough. Buffett also stresses the importance of research. Before investing in a company, it's crucial to understand what the company does, how it makes money, and its place in the market. This requires time and effort, but it's a crucial step in making informed investment decisions. It's not about betting on a hunch or following the latest hot tip. It's about making calculated decisions based on solid information. And then, there's the understanding of the businesses you invest in. Buffett believes in investing in what you know. If you can't explain in simple terms how a business operates and makes money, then it's probably not the best choice for your investment. Understanding the business means knowing its strengths, weaknesses, opportunities, and threats. It's about recognizing its potential for growth and being aware of the challenges it may face. Why is all this important? Because investing is not a game. It's not about trying to outsmart the market or timing your moves perfectly. It's about investing in quality businesses, being patient, and allowing your investments to grow over time. It's about understanding the value of a company, not just its current price on the stock market. Investing in the stock market is not a race to get rich quick. It's a methodical, patient process of growing wealth over time. It's about making informed decisions and sticking to them, even when the market fluctuates. It's about understanding the businesses you invest in and believing in their long-term potential. So, when you approach investing, remember Warren Buffett's words. The stock market is not a place for the impatient. It's a place for those who are willing to do their homework, understand the businesses they invest in, and have the patience to wait for their investments to bear fruit. As Buffett reminds us, investing is not a game. It requires patience and a long-term view. Warren Buffett's second rule for investing pertains to diversification. He says, do not put all eggs in one basket. This phrase, as simple as it sounds, carries profound wisdom that can save you from financial pitfalls. So what exactly does Warren Buffett mean by not putting all your eggs in one basket? He's talking about the concept of diversification. Diversification, in the world of investing, means spreading your investments across a variety of assets to reduce risk. Imagine walking on a tightrope. If you were to stumble, you'd want a safety net to catch you, wouldn't you? Diversification acts as that safety net in your investment journey. Now, let's dive a little deeper into this concept. When you diversify, you spread your money across different sectors, asset classes, and geographical regions. This way, even if one sector or asset class underperforms, the others can offset the loss. It's like placing small bets on multiple horses in a race instead of betting everything on one horse. You may not win big, but you're less likely to lose everything. But here's where Mr. Buffett's approach to diversification differs from conventional wisdom. While most financial advisors would advocate for broad diversification, Buffett believes in concentrated diversification. He once said, "Diversification is protection against ignorance. It makes little sense if you know what you're doing." What does he mean by this? Well, Warren Buffett suggests that instead of spreading your investments thin across numerous stocks, you should invest in a select few companies that you understand well and believe in. It's about quality over quantity. However, this strategy requires a deep understanding of the business and the market. But beware, this doesn't mean you should put all your money in one or two stocks. Even Buffett's Berkshire Hathaway portfolio is diverse, but it's concentrated on a few sectors that he understands deeply. His portfolio is a testament to his belief in concentrated diversification. So how can you apply this rule to your investment journey? Start by understanding your risk tolerance. Then diversify your portfolio based on your risk appetite and knowledge of the market. If you're a beginner, it's safer to diversify broadly until you gain more market knowledge and confidence. Remember, investing is a marathon, not a sprint. Don't rush into making high-risk investments. Take your time to understand the businesses you're investing in, the sectors they operate in, and the overall market conditions. And finally, always be prepared for market fluctuations. Even the most diversified portfolio can face losses due to unpredictable market events. The key is to stay patient, stay informed, and stay diversified. Remember, don't put all your eggs in one basket. Diversification is key to reducing risk. Our third rule from Warren Buffett is perhaps the most famous. He advises us to be fearful when others are greedy and greedy when others are fearful. What does this mean? Let's dive in. The concept at the heart of this rule is market sentiment, a term used to describe the overall attitude of investors toward a specific security or financial market. It's the general feeling or tone surrounding the market, whether that's optimism, pessimism, fear, or greed. Market sentiment is incredibly influential. It can drive markets up or down, and it's this fluctuation that creates investment opportunities. Picture the stock market as a pendulum, constantly swinging between unsustainable optimism, which we could call greed, and unjustified pessimism or fear. When greed is at its peak, that's when the market is in a bubble. Prices are inflated, driven up by the collective belief that they will continue to rise. This is when others are greedy, but remember, what goes up must come down. Now let's flip that. When fear is at its peak, the market is in a slump. Prices are deflated, driven down by the collective belief that they will continue to fall. This is when others are fearful, but just as the pendulum swung one way, it will swing back the other. So how does Warren Buffett use this rule to find undervalued stocks? Well, it's all about contrarian investing. When others are greedy and the market is high, he becomes fearful. He knows that inflated prices can't last and a correction is imminent. He holds back, he waits. He understands that the greatest opportunities come in times of maximum pessimism. And when others are fearful and the market is low, he becomes greedy, not in the sense of blind, unthinking greed, but in the calculated, strategic pursuit of value. He knows that the market will recover, that the pendulum will swing back. He sees the fear, the pessimism, and he recognizes it for what it is, an opportunity. Buffett isn't swayed by market sentiment. He doesn't follow the crowd. He sees past the fear and the greed, and he focuses on the underlying value of a company. He knows that price and value are not the same thing. The price of a stock is what you pay, but the value is what you get, and it's the value that matters. In this way, Buffett uses market sentiment to his advantage. He uses it to find undervalued stocks, to buy low and sell high. He uses it to make calculated strategic decisions, to build his portfolio, and to grow his wealth. So, take a leaf out of Buffett's book. Don't be swayed by the market sentiment. Don't follow the crowd. Look for the value, not the price. And remember, be fearful when others are greedy. In the words of Warren Buffett, price is what you pay, value is what you get. So be fearful when others are greedy. Now that we've explored Warren Buffett's 3 rules for investing, let's summarize and discuss how you can apply these to your own investment strategy. Let's recap. Rule 1. Investing is not a game. It's important to understand that investing is a serious commitment, not a quick way to make a few quid. It's about long-term wealth creation, not short-term gains. So, don't treat it like a casino. Instead, approach it like a business. Be analytical, patient, and disciplined. Just like Warren Buffett, remember that every investment is a commitment of your hard-earned money. Rule 2. Don't put all your eggs in one basket. Diversification is key. By spreading your investments across different asset classes, sectors, and geographies, you can manage risk and increase your chances of success. Don't just rely on one stock or sector, no matter how promising it may seem. Remember, even the most successful companies can fail, and market trends can change rapidly. In the immortal words of Buffett himself, diversification is a protection against ignorance. And finally, Rule 3. Be fearful when others are greedy. This rule encourages us to go against the crowd. When everyone else is buying, it's often a good time to sell. And when everyone else is selling, it's often a good time to buy. This contrarian approach can be challenging, but it can also lead to significant rewards. As Buffett cautions, the stock market is a device for transferring money from the impatient to the patient. So, how can beginner investors apply these rules? First, educate yourself. Read books, attend seminars, and follow reputable financial news sources. Knowledge is your best weapon in the world of investing. Second, start small and diversify. You don't need to have a lot of money to start investing. Even a small amount can grow significantly over time, especially if it's well diversified. Third, develop a long-term perspective. Don't be swayed by short-term market fluctuations. Instead, focus on the long-term potential of your investments. And remember, investing is a journey, not a destination. It involves continuous learning, adaptation, and patience. It's not about getting rich quick, but about building wealth over time. So don't be discouraged if you make mistakes or suffer losses. Instead, learn from them and use them as opportunities to grow and improve. In conclusion, remember that the rules we've discussed today are not hard and fast laws, but guiding principles that can help you navigate the complex world of investing. They're based on the wisdom of one of the world's most successful investors, but they're not a guarantee of success. As with any advice, it's important to consider your own circumstances and goals before making any investment decisions. And one more thing, don't be afraid to seek professional advice. Investing can be complex and risky, and it can be helpful to have an experienced guide to help you navigate the twists and turns. As Buffett himself says, it's better to hang out with people better than you. Pick out associates whose behavior is better than yours, and you'll drift in that direction. Remember, as Warren Buffett says, investing is simple but not easy. So keep learning, stay patient, and happy investing.